Today, we're going to be talking about sequence of returns risk and how to plan for it in your retirement planning efforts. Sequence of returns risk is the risk of negative market returns near or during the time when you will take withdrawals from your retirement assets. And it's particularly pernicious for people that are within 5 to 10 years of retirement or in the first 5 years of their retirement because it has an exponential effect on portfolio depletion. Welcome back to Navigating the Retirement Risk Zone. I'm Eric Amzalag, a certified financial planner and retirement income certified professional. I'm also the owner of fee-only financial planning firm Peak Financial Planning. For the next 15 to 20 minutes, we're going to do a deep dive down the rabbit hole of sequence of returns risk. Not from an academic perspective, but from a very practical, how do you plan for it perspective. I'm going to explain what it is, how to understand it, and how to plan for it in your retirement planning efforts. And be sure to stick around for the back third of this podcast, because that's where I'm going to address the investment-specific strategic elements of how to plan for sequence of returns risk. So there are two layered principles that make up sequence of returns risk. The first layer is what's called the unequal relationship between market declines and positive market returns. So I'm going to give you a real-time example of this. I'm going to ask you a really quick question, which is when your portfolio has a 10% loss in the portfolio, how much gain do you think is required in order to recover just back to break even? So I'll give you a couple seconds to think about this. If you lose 10%, how much gain do you need to get back to break even? And the answer is when you lose 10% of your portfolio value, you actually need 11.11% of a market return to get back to break even. There is what's called an unequal relationship between market declines and market returns. And that's because when you lose value in your portfolio, your new starting principal amount or your new baseline portfolio value is the lower value. An easy, quick math example, if you have $1 million portfolio, and you lose 10% of the value, that leaves you with $900,000. You lost $100,000, which is 10%. You're left with $900,000. In order to get back to $1 million, you need a rate of return that is based off of your new $900,000 portfolio. So you need an 11.11% return because you need $100,000 of growth to get back to $1 million. And this relationship becomes bigger and bigger the greater the loss. A 20% market decline, or let's say portfolio decline, needs a 25% rate of return, or a 25% return, not rate of return, 25% return to get back to break even. A 50% market decline requires an 100% return to get back to break even. Now, I'm not saying that because 50% declines are likely, but only to illustrate this kind of exponential spread that happens as the losses get larger, okay? Now, the most important part of this example is not just how big of a return you need in order to break even, but how long it takes to get back to break even. And the answer is if you use the historic average return of the S&P 500, which is 7.44% after inflation, then if you have a 10% decline and you need 11% roughly to get back to break even, that takes 1.5 years. If you have a 30% decline and that requires a 43% recovery to get back to break even, that can take 5.75 years. Now, obviously, circumstances will be different person to person based on how their portfolio is invested, but also based on the market returns after the decline. But the idea here is if we're using historic data to give us an indication, this just illustrates what I call the unequal relationship between declines and returns, and illustrates how much longer it takes than we expect to get back to break even if we lose portfolio value. Now, that's the first layer of sequence of returns risk. The second layer is what happens when we add in distributions on top of market declines. So what if you're retired and you're drawing income from the actual portfolio? Well, let's say when you have a 10% market decline or a portfolio decline, and you take a 4% distribution from it, now you've withdrawn 14% effectively from the portfolio. There's that 10% loss and the 4% distribution, and you need a 14.9% recovery to get back to break even. Again, the relationship gets exponentially worse the bigger the decline. If you have a 20% decline, let's say in 1 year, and you also take 4% out, now instead of needing a 25% recovery to get back to break even, you need a 28.6% recovery to get back to break even. And that is actually what sequence of returns risk. It's when you combine this unequal relationship between market declines and market recoveries, or portfolio declines and portfolio recoveries, with also taking distributions from the portfolio. Now, Why is this particularly pernicious? And it's particularly pernicious and dangerous when using retirement planning tools. And that's because most retirement planning tools will default to using straight line rates of investment returns in their illustrations or in their analysis. What that means is most retirement planning tools, if you plug in your asset allocation, it'll generate an average rate of return. Let's say you do a 60-40 portfolio and it spits out that 60-40 portfolio has historically had a 6% rate of return year over year. It's going to apply that 6% rate of return to every year for the rest of your plan by default. The problem is markets don't actually work that way. You have different rates of return every year. You may have an average of 6% over a 30-year period, but there is no scenario ever in reality where you will have a flat 6% rate of return every year in retirement. Most of us intuitively know this, but if we don't look under the hood of the retirement planning tool or use some of the suggestions I'm going to give later in this podcast, then we're going to get blindsided when we look at the probability of success in our retirement planning tool and don't understand that this is using a flawed investment rate of return application. Which leads us to the most important part of this podcast, which is how do we plan for or protect against sequence of returns? I believe there's a three-part strategy to this. The first part is what I call comprehension. First, we have to understand the layers that lead up to sequence of returns risk so that we can make good decisions with our strategy. And that means, number one, understanding the two components mentioned before, which are the unequal relationship between market growth and market declines, or you could substitute the word portfolio growth and portfolio declines, and not just understanding the unequal relationship, but also understanding the exponential amount of time it takes to recover those losses. The second part of comprehension is understanding how portfolio withdrawals additionally impact the recovery timeline. Okay, so we just covered that. Now, the second part of planning for sequence of returns risk is proper retirement planning. And we addressed this a little bit, but the first element of this is, number one, don't rely on Monte Carlo or retirement planning tools' probability of success. It will mislead you. You need to look deeper than just using a probability of success on a retirement planning tool. And the way you do that is you stress test your financial plan with multiple investment rate of return scenarios. You can actually, in many tools, build in your own rate of return sequence of returns. You can also download historic rates of return online and apply those to a financial plan. Now, you also want to use multiple withdrawal and spending strategy scenarios as well. So it's not enough to just think about the rates of return on investments. You have to combine that with the actual spending strategies or spending behaviors that will likely get used in retirement. So that is layer 2 of how we protect against sequence of returns risk, which leads to finally layer 3, which I think is what most people are most interested in, which is the investment strategy. Now, I recommend, this isn't financial advice, but I recommend thinking of your investment strategy this way, which is a bottom-up withdrawal strategy first, and then your investment strategy. All right. Now, most of the time we begin with the investment strategy first, which is building an asset allocation and then filling the investments in that satisfy that asset allocation, and then filling in a withdrawal strategy that supports that asset allocation. It's important to still always have the asset allocation in mind, but I recommend that when planning for sequence of returns risk, we flip that kind of upside down. And we start with simple withdrawal rules first. And this is actually practically applicable to managing sequence of returns risk. The first withdrawal rule would be something like the following. Take withdrawals from portfolio growth when portfolio values are up in order to preserve cash and cash-like investments that are held within the portfolio. And then take withdrawals from cash and cash-like investments when portfolio values are down to allow time for investments that have lost value to recover. I'm going to repeat that. Simple withdrawal rule that helps with sequence of returns risk. Withdraw from portfolio growth when portfolio returns are good in order to preserve cash and cash-like investments. And then withdraw from cash and cash-like investments when portfolio values are down to allow time for investments that have lost value to recover. That makes sense. That probably sounds a lot like a bucket strategy, and it kind of is, although I'm not necessarily telling you that you have to use a bucket strategy, but you do want to think of your investments in buckets. And the reason we started with this withdrawal strategy is because now, depending on your ability and level of wealth, we want to build an asset allocation that will support the withdrawal strategy I just mentioned. Withdrawing from portfolio growth when portfolio values are up, withdrawing from cash and cash-like investments when portfolio values are down. Okay? Each person, and every one of you listening to this podcast or watching this wherever you watch it, will need to determine the amount of cash and cash-like investments that they can support in their portfolio and still meet their desired spending needs in retirement. That's a completely unique and individual exercise. Some people with more wealth will have more ability to have more cash and cash-like investments in their portfolio, and people with less wealth will have less flexibility with how much cash and cash-like investments they have in their portfolio, and to still be able to meet their rate of return requirement and therefore how much they want to spend. Now, having said that, let's move to the next step. So we've talked about the withdrawal strategy. Now we talked about the asset allocation concept, which layers on top of the withdrawal strategy. Now we're going to talk about how you do the investments that fill in or support the asset allocation. So the idea would be to choose specific investments that fill in the asset allocation and actively support the hedging goal you have in mind. Hedging meaning the insurance goal, right? We are using an investment strategy here, or we're proposing an investment strategy here that hedges against sequence of returns risk by giving you a withdrawal strategy that helps you preserve declined in value investments by using cash and cash-like investments, and allows you to preserve cash and cash-like investments by using portfolio growth in the opposite scenario. And we want investment-specific selection that fills in the asset allocation that supports this. So I'm going to give you a quick, easy example of where people have gone historically wrong in thinking about how to invest for protection against sequence of returns risk. The easiest example is intermediate and long-term bonds. So if you use a traditional asset allocation and it tells you to go 60% stocks and 40% bonds, you might, and many people suffered from this in 2022 when the market declined and when interest rates went up at the same time. Many people had intermediate and long-term bonds that are in the bond portion of their asset allocation. Their advisors or themselves or online, they were told or made to believe that these were low volatility investments because they're in the conservative portion of their portfolio, and that in some ways these might function as cash or cash-like investments. And to add on top of that, because interest rates were so low, many people may have been more heavily indexed into the longer end of the bond curve, or longer duration, longer timeline bonds, because they were getting slightly more interest than the lowest interest rate and shortest term bonds. And because of that, they suffered major portfolio value declines and did not have a sufficient cash or cash-like bucket because too much of their bond money was invested in the wrong types of bonds. And this happened because the asset allocation says that the bond part of the portfolio is the defensive part, and they ended up in this kind of train wreck that could have been avoided if they had understood this problem. So the point here is choose your investments specifically so that they satisfy the cash and cash-like portion and how much you think you need in that type of bucket, and how much should go into the growth portion that you will use to prune in positive market return years. The last part of the investment strategy here is probably the most controversial, which is to diversify out of concentrated positions. It is my opinion, and I think the data shows this, that having more individual investments reduces concentration risk. That's the concept of diversification, right? We're told that we should invest in the broad stock market, or a basket of stocks or maybe index funds that spread our money around many investments, because that reduces concentration risk and increases diversification. Concentration risk, by the way, specifically means having too much money in one investment, and then if the market or that investment specifically goes down because it's too large a proportion of your investment monies, it drags your whole portfolio down. Having more positions reduces that concentration, and it allows for what I call investment-specific pruning when markets decline. And what I mean by that is not all stocks, or not all funds for that matter, go down just because the market as a whole goes down. Actually, in many cases, we've had markets that have declined, and there have been specific funds or specific stocks or specific sectors that did not decline with the broader market. When you have more diversification in that manner, you can prune those specific investments because they may have grown or have stayed flat, and that can act as another buffer to protect against this sequence of returns. As a real life example, a 3-fund portfolio only has so many areas where you can prune while waiting out a recovery. And we might be told that a 3-fund index fund portfolio, because it's invested in index funds, which are the index funds themselves are invested in a broad basket of stocks, or the market as a whole are diversified. The fact of the matter is they're not actually diversified when it comes to withdrawing money, because you can't actually only sell, like if VTI, an index, a S&P 500 index fund goes down in value, you can't go to your account and say, I only want to sell the energy sector of this fund because the energy sector was actually up while the rest of it was down. You can't do that. You have to sell the fund itself. You can't prune in specific manners. And so that's a good example of where having more diversification, maybe more funds or more stocks, or maybe even using some blend of funds and individual stocks along with your cash and cash-like investments, can actually be a hedging mechanism for sequence of returns risk. Now let's put this all together, because thinking about planning for sequence of returns can feel kind of yucky. The problem with hedging against sequence of returns risk is that when markets are going well and your portfolio values are going up, we just think we don't need to hedge against sequence of returns risk. However, hedging is like purchasing insurance. In many of our lives, in many areas of our lives, we buy insurance. We hope that we'll never need to rely on that insurance, and we'll be thrilled, if we die and having paid the insurance premiums our whole life, but never had to call upon the insurance. And we still purchase that insurance because it's prudent, right? So portfolio strategies to protect against sequence of returns risk serve the same function. When markets are going up, like I said, it's going to feel very unpleasant to watch the hedging portion of your portfolio underperform the rest of the portfolio. But I'll leave you with this final reminder, which is it's not an investment strategy if you don't have a hedge. That is called gambling. And so you can think of the strategy we outlined in this podcast as portfolio insurance for the eventual possible contingency where sequence of returns might negatively affect you in retirement. As a financial advisor myself and as just a nice person, I hope it never affects anybody that I ever work with. It doesn't affect any of you watching or viewing or listening to this podcast. But just like insurance, we purchase it for the contingency where it might happen. And so that is basically the podcast here on sequence of returns risk. I hope you enjoyed the topic. Please give this, subscribe to this podcast wherever you may listen. It would be a great help if you could write us a review, let us know your thoughts or your comments on this episode or the other episodes. And if you'd like to learn more about how we help our clients at Peak Financial Planning, you can visit our website at www.thepeakfp.com. Thanks for your time and attention, and see you soon.